Our next guest, who, as we have pointed out quite a bit, accurately called the rally last year, and he was really lonely, says he's now very cautious on the market this year and favors value over growth stocks. Barry Bannister is chief equity strategist at Stifel. And I can remember I was complaining about how wrong everyone had been. And I think your people contacted us and said, here's the proof. And then you started coming on more. But I can vouch for what I just said on the air, that did happen. And no, was there any, what would you say? It was about 5% of the street was bullish when you first got? 1 out of 20 of the people we have on. We still have on.
Well, I've always been better at bottom fishing than top ticking, and that's just my nature. We've had the view since last year that 2022 to 23 actually had a recession. That if you look at a recession, it's income, production, sales, employment, and fixed investment. The only thing that didn't weaken was employment. We're structurally short labor. We had a recession in everything else, like real retail sales. And so what we're doing now is recovering from a recession, which is why you've had this burst of productivity after a recession.
Not a classic recession.
No, we call it pseudo-recession. It was a major slowdown, like the mid-teens. We had one in the 80s. We had one in the O's. And because of that, the actions of the market are very much like a post-recession recovery, and that's what caught the Fed off guard, as the economy came back.
So why does that make you less bullish?
Well, when you think about it, the yield curve is inverted, meaning short rates are above long rates. And I think the yield curve will flatten. And a lot of people think, well, it's because the Fed's going to bring the short end down. But I actually think the long rates will go up. 5 was the norm before the financial crisis in 08, 5% on the 10-year. I think we'll see 5 again. And they'll cut a little bit, but their problem is messaging. You know, in the Greenspan Fed, and even Bernanke, when he took over from Greenspan, they kept rates at about 5. And so the Fed can cut a little bit and manage it like course corrections in a boat, but they can't really whack rates like they did in the last decade.
So your view on whether stocks continue to perform well is based on whether the Fed cuts or not?
No, the Fed is extremely important. I mean, you know, the market is the liquidity and rate-driven second derivative machine. But we just thought valuations and some of the the AI hype was a little overdone. So what we're looking for is a 10% correction off March 28th, which takes you down to about 4750 on the S&P 500. We'll trade around these ranges through the summer.
The E could be okay. The earnings could be okay, but the multiple might not. It might already be as good as it's going to get.
We had a minor earnings recession outside of tech. I mean, it was negative outside of just
better now, aren't we?
Yeah. And so what you're seeing is earnings, employment. These are all late cycle phenomenon. And after the pseudo recession, you're going to get the recovery. So the Fed has to be on guard to that reacceleration.
Why a 10% correction with earnings going up 10%?
That's just it. The earnings aren't probably going to struggle to do 10 this year. I think it'll be a little south of 10.
So it's going to be multiple.
It's multiple compression as people realize that the interest rates have to, the normalize of interest rates is up. And it gets complicated. It has to do with R-star neutral rates, term premium. But generally speaking, we think we're in a higher rate environment for the long term. Multiples just got a little elevated on some of the hype, and that's what's got to come down.
Your hair's not on fire about inflation being worse than we're expecting. The Fed's going to have to actually tighten down the road instead of cutting. You just think we got ahead of ourselves. We get a 10% correction, and then we're back on track after that?
Well, the post-World War II average for the CPI headline inflation number is about 3.7% year over year, and 3 looks like we're going to be sticky at that level on the headline. So the core PCE inflation the Fed watches is about 2.5%.
Okay.
And a 2.5% core PCE world, the Fed's going to think, well, depending on the growth potential of the economy, we've got to keep rates a little closer to 5 than to 4, and that's what the adjustment is. The long end is going to be higher than the short end, and the short end is going to be higher than what people are used to.
When will you be as bullish as you were last year?
We'd have to have another bear market, and I do think there will be a bit of what we call a term premium shock that people are going to realize in 2025, next year. that the economy is bumping up on resource constraints. Inflation will bottom out and gradually turn up. Before he leaves office in May of 25, I think it is, I think Powell might be hiking rates again. And then the market would sell off again, and we get another great entry.
We've had a lot of.
You think a bear market 20% down?
Yeah, that's probably more of a 2025 story, though.
But we do 10 this year, correction.
A 10% correction.
47.50 on
another
the
20%
S&P.
that you're saying.
And then
No, I think we rally back. If you think back to the end of the year, we're going to have a relatively resilient economy, and what we've been focused on, we call it cyclical value. This would be a broadening out into financials, industrials, energy, basic materials, industrials. Some of those have already moved. But we think it'll broaden out in the fourth quarter. It'll be less tech-centric in terms of the recovery. But seasonally, I'm a little concerned between May and October. I just don't fight that too hard.